I'd like to show an example of how you could have used both today and take some trades. So first we're starting on our high time frame, which is our daily. I'm going to go ahead and mark up liquidity. So the immediate thing obviously that I see is a fair value gap here. And I also see an imbalance in price here. An imbalance in price is where there is no body and only wick. These areas are super strong and act like magnets for price. So I just like to label them with orange boxes. If I go down to the hourly, I'm going to label my sell side and buy side liquidity. So I have buy side here. We have sell side here. And then let's go down to a 15-minute and get closer into the evening trading for last night. So we're just gonna let price play out. And now we're at today, so this is midnight here. And we're gonna see what the London does. I personally do not trade the London. I just let price do what it does, and I usually start looking around 7:30, 8 o'clock in the morning. So as we get towards 8 a.m., I'm going to pause the replay, and I'm going to go ahead and mark up what I see now as liquidity. So that we're taking this as if I woke up this morning and this is what I would be doing around 8 o'clock. So I would see that overnight we took out liquidity on the sell side, and we also set equal lows, which is our new sell side. We also have a fair value gap over here to the left. This is on the 15-minute time frame. I'm going to go ahead and highlight that. And we also have buy side liquidity resting above these highs. I'm going to also highlight that. And now we're going to go into the 5-minute time frame, because this is the time frame I'm mostly watching. I do flip back and forth between the 15-minute and the 5-minute, but as if I'm watching price live, I'm probably looking at it like this. I'm also going to go ahead and label these equal lows here with sell side liquidity, because if we trade up and fill this gap and start to fall back down and break structure, I would be looking for us to take these out as low-hanging fruit first. And let's see if I see any other gaps in here. I do. There's a small 5-minute gap here. And that's about all I see here on the 5-minute. So we're going to let price go up and play out. See what happens next. Okay, so we come into the fair value gap. We are almost about to fill it, and right now it's 8:30. There was no news at 8:30 this morning, so no crazy volatility at that time. And then I see that we set relative equal highs here. Price is now starting to trade down with a little bit of force before the open at 8:40. And then we also set a small 5-minute fair value gap here. So knowing what we know about gaps, we do know that you can take gaps short. You can either try to fill them, or you can take a short from the bottom of the gap. So you would be taking a risk shorting here due to this fair value gap not being filled. So it could shoot through here, but if that's a risk you're willing to take, betting that we go take these equal lows and maybe even these equal lows or even just to this gap, then you could short right here. So let's say we entered a short position at 36.19. You could even have your stop right above these highs, a 9-point stop, and then your target would be low-hanging fruit, sell side liquidity equal lows, 17 points. So 1.84 risk to reward ratio, which isn't a bad trade. Now let's see if price actually comes up into this fair value gap and then sells back down. Boom, into the gap. So at this point we'd be in the trade, in drawdown a little bit. and then price continues its way on down. And then your target would be filled here. And let's say that you had a runner and you left it to go to the gap. That gets filled as well. And that would have been 20 points from your entry up here in this fair value gap. At this point, you can take the trade off because one, it's 9:30, so the market is now open, and there is going to be a lot of volatility here. But if you have a runner and want to leave it and just cover your entry, go ahead. So next, I wouldn't want to buy this fair value gap here just because we like the most recent price action. So I'd rather short this than buy this because price is flying at you and there is no guarantee that it won't come and tap these equal lows here. So let's see what it does. Price comes down, takes out these equal lows, sell side liquidity. And now we're waiting at this point to see if we get a long setup. If you're looking for gaps, ICT trades this way. So after sell side liquidity is taken, he even goes down as far as to the 1 minute and looks for a fair value gap, and will take that fair value gap long after major sell side has been taken out like this. And if we look here, there's a gap on the 1 minute. You could take this 35.87 long, have your target above these highs, and you could even go as far as say back above these highs in this fair value gap if you're willing to let it run that long. Obviously those would be runners. Low hanging fruit would be buy side here, buy side here, and here. It's easier to label your buy side liquidities on a higher time frame other than the 1 minute, but for this trade, if we are going to take it long, you can see that we would have our target at 11 points, our first low hanging fruit, and to have your stop below the low would be 7 points. So a 1.42 risk reward ratio. If you let a runner go, 16-point target. If you let it keep going, 23-point target if the market can get way back up there. And the reasoning to think that it could potentially get back up there is you could draw your fibs from the high to the low, and equilibrium is 36.04. Price trades from discount to premium, premium to discount. So this is premium. It traded down to discount, took out sell side liquidity, and at minimum it will probably get back to equilibrium at 36.04. So that's another way you can trade this as well, using your fib levels. I'm not saying enter on the fibs, but you could exit using the fibs logic to know, hey, we're back in premium territory. It could be loading to go short again. So I would exit and get out of my trade. But if we go back to the 1 minute and look for this gap, let's see what price does. And let me get rid of these fibs. Price comes down, wicks into the gap, picks us up, and then continues to trade higher. Now it's coming back to the gap. Let's see if it gets in there. All right, so at this point we would be down in our trade about a tick or two. Taking some drawdown, and then price wicks back up after trading into the gap further. Now let's see if we can take out buy side. Oh, we're taking some more heat. We're back here down in sell side liquidity, near sell side, the original sell side liquidity. We're taking about 35.85. We're down about 2 points at this point. Price wicks back up. It starts its explosion up. Boom. First buy side target hit. Price continues higher. And you can always tell that these are sensitive areas because look how price hits them and sells down a little bit. Hits them, sells down a little bit. Look, ran this buy side, selling down a little bit. At this point, You are up almost over 20 points in the trade. You could take it off here if you want to. But obviously 20 points is a great day on the ES. But let's see what price does. And now that I see price starting to retrace down here, I'm actually going to go back to the 5 minute. So if I was in this trade, at this point, you at least need to have taken some profit. But I want to see how price is moving on a higher time frame, because it can be easier to confirm whether or not you're going to continue to go higher or go lower. So on a 15 minute, I actually don't see any gap forming here. On a 5 minute, I see a gap here. And let me delete some of these older gaps. Some of this old stuff, clean our chart up. We don't want any low vibrational charts. But I see a gap here. So I know that price could retrace into here and continue higher. But I don't see anything else on the 5 minute that would indicate we should keep going lower. So let's see what price decides to do. Okay, so we trade into this fair value gap and we actually close a little below it. And then price continues upwards. So on the 5 minute, we retraced and we took out those other sets of buy side liquidity. And now what I immediately notice is that we set relative equal highs here, which I think will get run. And let's go back and see on the 1 minute how price reacts to this. So there's a fair value gap here. And there's one here. And now I actually took this trade today on the 1 minute. And I entered at the top, around the top of this gap here, with my stop just below it, right here. So I went long here. And my target were these relative equal highs above. So 20-point target, and my stop was around 9 points, give or take. I think my entry was 3607.50. So we're looking on the 1 minute, price is trading down into this gap. We're expecting it to continue higher, and we know that it's at equal highs. So at this point, let price do what it does, and it continues higher. Eventually going up and hitting my target. And another interesting thing that happened today, and there we are at this point, I am out of the trade, and we've filled this 15-minute gap here. Let's get rid of some of this noise. All of these are already taken. And I do want to see if price can get up here. At this point, I'm not in the trade. It's lunchtime. And it does right at 11:45. Retraces back down. Now, if you're expecting price to continue higher, maybe into this imbalance that we got from the daily, that's likely as well. So you could try to take this fair value gap, but at that point, you're trading at a premium and you're trying to go long at a premium. And it's a harder trade because where are you going to put your stop loss? So if you were to go long here, even if you went from the bottom of the gap to the imbalance, where's your stop loss going to go? Because price could come and take this low, it could take this low, or it could just continue down. So it's kind of not a good trade, even though there's a gap there. You just have to have some logic and narrative behind why you would take the gap, not just take any gap you see. And price continues up. And if you notice, price perfectly taps the top of this imbalance. And let's see what happens the rest of the day. A little bit of consolidation through the lunch hour, and now it's 125. Price sells down, but doesn't quite break structure yet. We would like to see price break market structure, which would be closing below this black line. Clearly price had not wanted to do that, still doesn't want to do it. And then boom, we finally get a small closure below market structure, so it's a break in market structure down. We get another one. And if you also pay attention, there's a small fair value gap here on the 5-minute. Very small. You have your break in structure. You have the rejection off of the top of the daily imbalance. And you could take this gap short if you wanted to. With your target, your first target being sell side liquidity at 36.17. Equal lows here at 36.05. Again here at 35.97. And you have your targets for your short. You take the short, you can enter in this gap, have your stop above these highs, 6-point stop, 20-point target for your low hanging fruit, which is crazy, 32-point target for your next sell side liquidity, 40-point target for your next level, which obviously these would only be runners. Do not hold your full position for 40 points because you will not get it every time. But let's see what happens. Price wicks up a little over the gap, but not quite at our stop. Comes back down and sells off right into sell side liquidity. Remember, price trades discount to premium, premium to discount, and it seeks liquidity every single time. And what does price do? Takes out the low from earlier today and reverses back up. Closes the day on a small retrace. And traded from premium to discount, discount to premium, all day long, taking out liquidity and seeking liquidity. That's how you could have traded gaps using liquidity today. Thank you guys for watching. Hopefully this was helpful. If you'd like more content like this, let me know in the comments, and see you guys later.